Have you ever stared at a chart and thought to yourself, how is it possible that price keeps reacting to the same hidden zones over and over again? Almost as if someone behind the scenes is controlling everything. And why does it seem like some traders instantly recognize these zones while everyone else keeps getting trapped, stopped out, or entering at the completely wrong time? Today I want you to imagine something simple. Picture a candle moving insanely fast, almost like a rocket. Now imagine the market leaving behind a tiny empty space while it jumps forward. That little space might look harmless, but it is actually one of the most powerful clues you can ever learn to read. And inside that clue lies a secret I found about fair value gaps that most traders have never even heard of. Once you understand this, your entire view of charts will change forever. And I'm saying this because it happened to me too. For years, I was struggling with fair value gaps. Some worked beautifully, others failed instantly, and no matter how precise my lines were, I always felt like something was missing. But then I discovered a technique, a detail so small that most traders completely overlook it, a detail that instantly tells you which gaps matter and which gaps should be ignored without hesitation. Before I reveal that, let's make sure we are on the same page about what a fair value gap actually is, because the idea is extremely simple. A fair value gap happens when price moves so fast in one direction that the opposite side never gets the chance to respond. Imagine buyers smashing into the market so aggressively that sellers cannot even place an order in time. This creates a huge candle, and that huge candle leaves behind an imbalance, like an empty pocket waiting to be filled. You can spot a fair value gap by marking the wick of the candle before the big move and the wick of the candle after the big move. The empty distance between them is the fair value gap. If you pull up your chart right now, you will see them everywhere, almost like little footprints left behind by big money. And what usually happens is that price eventually comes back to fill that imbalance and then continues in the original direction. So if price rockets upward, forms a fair value gap, comes back down to fill it, and then launches up again, you can use that movement to your advantage and potentially profit from it. The problem is that it does not always work. And if you've ever traded fair value gaps before, you've definitely noticed this. Some of them seem perfect, yet they fail instantly. Others look too small to matter, yet they work beautifully. So what separates the fake ones from the real ones? This is where the secret begins. Fair value gaps are only reliable when they meet very specific criteria. And after testing hundreds of them, I discovered 6 factors that must be present every single time. When these 6 factors align, the probability of that gap working skyrockets. Think of it like layers of confirmation stacked on top of each other. The more layers you have, the stronger the gap becomes. And when all of them align, the reaction is often so clean and so predictable that it almost feels unfair. The first factor is simplicity itself. The fair value gap must be unmitigated. That's just a fancy way of saying price cannot have touched it before. Because the whole point of a fair value gap is that the market didn't have time to react the first time the candle moved. If price comes back and touches the gap immediately after it is created, that imbalance is already filled, and the entire idea behind the structure disappears. So if price returns to the gap too quickly, that gap is no longer valid. You want gaps that have never been touched, clean, untested, fresh. The second factor is the candle reaction inside the gap. Most traders ignore this completely, but it makes a massive difference. What you want is for the candle that taps into the gap to close inside the gap or close in the direction of the gap. For example, if you have a bullish gap, you want the candle to close above the lower boundary of the zone. If it closes below the gap or smashes right through it, that gap becomes invalid. A wick can pierce through the zone, but the close must be inside it. Think of this like confirmation that price actually respects the zone rather than rejecting it. The third factor involves confluences. Yes, fair value gaps can work by themselves, but when combined with support or resistance, their probability increases massively. So if you have a bullish fair value gap that lines up with a previous support, that gap becomes extremely powerful. And the same goes for bearish fair value gaps that line up with resistance. These overlaps are often the exact points where institutions enter, and price reacts almost perfectly when these confluences line up. The fourth factor is something most traders never consider, yet it dramatically improves your accuracy. You need to understand that some fair value gaps have higher priority than others depending on where they sit on the chart. For bullish setups, the lowest fair value gap is always stronger. For bearish setups, the highest fair value gap takes priority. This is because price naturally gravitates toward the closest unmitigated imbalance in the direction of the trend. So if you see 5 fair value gaps stacked one above another, the one closest to price is usually the strongest. The fifth factor involves using the GAN box tool. This tool essentially divides the movement into 2 halves. If you place the GAN box from the low to the high of a move, and most of your fair value gaps are sitting in the upper half of the box, you should ignore them. For bullish setups, you only want gaps in the lower half. For bearish setups, you only want gaps in the upper half. This little filter alone cuts out most of the fake gaps that look tempting, but almost always fail. Now we've reached the 6th factor, and it might be the most important one of all. Price must create a break of structure before forming the gap. A break of structure means price must break a previous high for bullish setups or a previous low for bearish setups. If no break of structure occurs, the fair value gap is weak and the probability of failure increases dramatically. But when a break of structure happens followed by a fair value gap, that gap becomes a high probability zone because it represents both strength and continuation. When you combine all 6 factors, something incredible happens. Fair value gaps suddenly stop feeling random. They stop feeling like lucky entries. They become logical, measurable, repeatable. You look at a chart, and instead of seeing chaos, you start seeing structure, intention, and order. It feels like seeing a graph with clearly marked points. You see the break of structure point. You see the priority gap. You see the GAN box midline. You see the untouched imbalance. You see the support or resistance overlapping it. You see the reaction candle closing inside the zone. Suddenly the entire chart becomes a readable map, like a graph where every line points directly toward your entry. To make this crystal clear, imagine a live example. Price pushes upward and forms a higher high. That is your break of structure. Then price creates a fair value gap. You check if it has been touched before. It hasn't. You mark the GAN box. The gap sits in the lower half. You check the priority. It is the lowest one on the chart. You look closer and notice a support level formed earlier that sits perfectly inside this gap. You wait for price to drop. It taps into the zone. The candle closes inside the gap. Everything aligns. Entry is perfect. Stop loss goes under the candle that formed the gap. Take profit goes at the high of the move, and then, as expected, price explodes upward from that exact zone. These kinds of moves, the ones that seem almost scripted, usually come from these deeply filtered fair value gaps. By combining all 6 factors, your accuracy improves instantly because you are no longer guessing. You're reading the clues left behind by the market. I hope this gave you clarity and opened your eyes to how fair value gaps truly work. This simple technique changed everything for me, and once you start applying it, your charts will never look the same again. See you in the next video. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.